Welcome, guys. Welcome for the first class. So, today we are starting with the first book, right, which is the quantitative methods. And in the first book, we are doing the first chapter, which is rates and return. Very easy chapter, especially, you know, since we are doing it for the first time, the first chapter. So, things are very easy initially. So, the syllabus is structured in such a way that, there is a kind of warm up before you go to the actual things. All right. So that's what we have to learn today. So not a very long module, not a very difficult module, easy module. If you have been out of touch of quants for very long, then it will give you some time to uh, feel good about it, right? You will see the concepts back. You will understand what is used, what kind of quantitative methods are used in finance, and that's what the objective is, right? So we'll try to cover that, and that's would be our schedule, guys. We'll start at 9:30, and 5 minutes we'll give students to join and get organized, and after 5 minutes we'll start, right? So we have to cover this today. We'll try to cover as much as possible today. If there is something pending, then we'll see what to do. Okay, so that is how we plan to go about it. All right. So when I talk about rates and returns, right, this is the most fundamental concepts of your finance, right? This particular topic lays the foundation for everything else in finance, especially when you're talking about your quantitative methods, right? Why it lays the foundation? Because you are talking about rates and returns. Rates and returns are important from your bond valuation to your equity analysis to your portfolio return measurement, everything, right? So we you know try to understand what interest rates actually mean, how they are structured, and how to measure your returns from investment in different time frames, different time periods, etc. Right? The whole topic is divided into your three parts. There are three modules. Module one is your interest rates and return measurement. Module two is your time weighted and money weighted rates of returns. And module three is your common measures of return, right? So that's how things are divided. And basically, the idea here is when we try to understand. So let me go to the next slide now. So the idea here is that in the first part, right, when you talk about your module one is about your interpretation of interest rate. We need to understand what exactly interest rates are. Very, very basic question. What exactly is an interest rate? So that we need to understand. Then what is the difference between nominal interest rate and real interest rate? What do you mean by your holding period return, right? And how it differs from different holding periods? And what exactly is your average return, right? We'll try to understand these three, four concepts. Guys, this like today is your first class and you're trying to understand all these basic concepts. So things will be pretty easy, kind of, but that's good thing also, but please don't expect the syllabus will remain same, right? So slowly things will start becoming harder. This is the first chapter, okay? So things are pretty basic and uh, easy here, okay? Moving on. So here we start, right? So let's try to understand the interpretation of interest rate. Now I'll try to highlight key things. Basically, the key thing about CFA study is that I told you, right? 40% time should go in active study, 40% should go in 40% time should go in passive study, 40% in active study, and 20% in revision. So we are not here to like remember, definitions, etc. We need to know the keywords, build the understanding. Ultimately, we have to solve the numericals and question. That is more important, right? So we'll spend more time there. Okay, so it's not a school exam, right, where we have to go verbatim on each and every definition, right? So we talk about the interpretation of interest rate, right? That is what I'm trying to teach you. Please understand when I talk about interest rate is the price of money. When I say price of money, means it represents the time value of money, right? Time value of money, or we can also say the compensation investors demand for deferring their consumption, right? So simple point, you keep your money in the bank, right? When you keep your money in the bank, you want to get compensated for what money you have kept in bank for what time, right? So it's the time value of money, right? In your financial analysis, the same rate can serve three different but related purposes, right? So three different purposes are these, right? So first one is your required rate of return. Now, what do you mean by required rate of return, right? Required rate of return is the minimum rate of return, right? It's the minimum rate of return, right? An investor is expecting for taking risk and postponing the consumption, right? So it is that equilibrium rate that balances your investors' willingness to save and borrowers' demand for fund, right? So it gives you the equilibrium. For example, right? I'll give you an example. Let's say if you can earn 6% risk-free rate in a bank FD, right? So if that is the case, you will buy a corporate bond if it gives you more than 6%, let's say 8%, right? The extra 2% compensates you for taking on that credit risk of that corporate bond, because you're saying that I don't want 6%, I'm going to a corporate bond because I want extra 2%. So you're taking some extra risk, right? That is why we invest money in equity markets, right? Because we say that, okay, in your treasury market or risk-free market, I'm getting certain rate, I want more return, and you want more return, you have to take more risk, right? So if you have something in mind that, okay, I need to earn at least 9% in a year, right? So that return 9% is your required rate of return which you want, right? So it is the rate that is, in other words, used to discount your expected cash flow. Why? To determine the present value or the fair price of the securities, right? So that's what is required rate of return. Next one is the discount rate. Now, what is the discount rate? Now, see, what I told you is that these all three, right? When I say about required rate of return, or I say discount rate, or I say opportunity cost, right? All three are your rates only, right? But they can serve different purpose. Those purposes are quite related in nature. Next, your discount rate. When I talk about discount rate, this is the rate used to discount your future cash flows back to the present value, right? So I'm pretty sure you guys have some idea about your compounding and discounting. So compounding is when you are saying that I have some money today and I want to know how much money I will have in future, right? Compounding is that, let's say you have $100 today and you are thinking that, okay, after 1 year I have, let's say 10% interest rate is there, I have 110. That is compounding. Discounting is that you have 110 after 1 year and you're saying that how much I have today, right? So you're going back, right? And you are 100, right? So discounting and compounding are two sides of the same coin. So when you have to find the present value, it is your future value divided by 1 plus r raised to power n. How did I get that? 110, 1 plus your r is 10%, 0.10, and raised to power 1, right? So if you 110 divided by 1.10, you do it, you get 100, right? So you are getting the same value, right? So discount rate is the rate used to calculate the present value of future cash flows. The terms, your interest rate and discount rates, are often used quite interchangeably because they both describe the price of time, right? So interest rate is when you earn when you are lending or investing. Discount rate is what you apply, right, when you are trying to value the future cash flow, which I did just now. So you can, when you try to value, you get the answer 10%, right? Third one is the opportunity cost. Again, please keep in mind very clearly that all three of them are rates only, but they are being used in different ways, right? Opportunity cost, when you talk about, this is the return foregone when you choose one investment over another. Now, little difficult to understand. What is important to focus here is that, let's say if you spend 1 lakh today on a vacation instead of investing at 8%, let's say. So your opportunity cost, you will say, is 8,000 because you have, 1 lakh rupees, right? And you are investing at 8%, right? 8 divided by 100. So opportunity cost is 8,000, right? So 1 lakh is 100K, right? If somebody doesn't know, it's 100K. If I have 100K money, right? So 8,000 is the opportunity cost, right? So the cost of using money today rather than letting it grow risk free or invest in the market, that is your opportunity cost, right? So overall, pretty straightforward, pretty basic. The first slide of your CFA level 1. Remember, these three rates are just three faces of the same coin. The required return motivates the investors, the discount rate values the investment, and the opportunity cost explain what's foregone by choosing one option over another. All three are expressing your time value of money. So the same thing is being expressed. And understanding the time value of money is kind of foundational for understanding of valuation, understanding of risk, as well as return, right? So very, very straightforward. If you have any question, please ask. But otherwise, I think initial topics are very straightforward. But please don't be in wrong impression that this is how the CFA is, right? The level will start increasing. The first few lectures will be very easy, but then things will start becoming difficult. Okay, so yeah, so it's good to start slowly, right? Second one is understanding of the nominal interest rate. Now, nominal is very interesting, right? So now that you understand what exactly an interest rate means, let's try to break it down what it's made of, right? What are the things which make an interest rate, right? So here we get something called nominal rate. Now, nominal rate is basically the quoted rate, right? It's the quoted rate. Quoted rate means what is quoted in the market, right? So nominal is a way people represent rates in the market, right? It's the quoted rate. Okay. Observed market rate. Quoted rate means observed market rate. Okay. So it is structured as a sum of fundamental components that compensate your investor. The total rate you see on your bonds, your deposits, or loans are called your nominal rate. It obviously consists of, uh, right, several parts, right? One is your risk-free rate, one is your inflation premium, one is your risk premium, right? So these three things compensate. So if I have to say nominal, please understand nominal is equal to your real risk-free rate. RFR is risk-free rate, guys. Inflation premium plus your risk premium. So nominal interest rate is is a sum of, right, three things, and we need to understand the three things, right? So first is your real risk-free rate. This one, real risk-free rate. Now talk about real risk-free rate. This is the theoretical. This is not the practical. This is the theoretical rate of return on a single period. Basically, a theoretical rate on a perfectly safe single period loan, assuming there is zero inflation. Why do we need it? Because it compensates for your time preference, the willingness to postpone your consumption. So let's say if you have, or if you lend, let's say 100 rupees for 1 year, the inflation is zero. And in that case, you're earning 103, right? So your real risk-free rate is 3%, right? But please keep in mind, you assume here zero expected inflation, right? That is very important. Okay. Next one is inflation premium. Inflation premium means that you're looking for compensation, right? Compensation for inflation. That's why we say now that inflation is eating away our savings, right? Inflation is increasing by 5%. I am earning 8%. So my real, saving is only 3%, right? So inflation premium is inflation reducing the purchasing power over time. Investors expect that compensation for that loss. And let's say if your expected inflation is 4%, right? You will demand 4% extra. Will say no. Inflation is 4%. I need to get 4% extra. Why? Just to maintain your present purchasing power you are having, right? So if your real risk-free rate is, let's say, 2%, inflation is 4%, right? Then you are getting what? 6%, right? 2 plus 4, 6%. Normally, normally when you combine these two, you get a nominal rate, because a lot of places you will say, people will only say that, oh, no, real risk-free rate on inflation premium combined makes the nominal rate. But we also need to keep in mind your risk premiums. These are compensation for distinct type of risk. These are, see, if in the normal scenario you don't add these, but in case you have some particular kind of risk which are not present elsewhere, right? You have to compensate investor demand extra return for different kind of risk. These are risk premiums which are added to the nominal rate, right? So you have 6%, and then you add the risk premiums in that. Now, if there is a chance of, let's say, default, right, you will add that premium. If there is a chance of, lack of liquidity premium, right, there is a chance of your maturity, right, maturity premium, right. So default risk premium is you're compensating for the possibility that borrower may miss your payments, right, especially if you have lower rated bonds, that case you will have default risk premium. So government bond, the default risk premium will be zero, but if you go to corporate bond, there will be some default risk premium. Maybe Adani will have higher, Ambani will have lower, maybe some other, you know, that kind of bond will have much higher, right? Similarly, liquidity, you're compensating for the risk that you can't sell the investment quickly at a fair price. So illiquid instruments, especially where there are less buyers and sellers, have higher liquidity premium, because you will not be able to liquidate the bond at a correct fair price when you want to. So that will be there. And then the maturity premium, long-term securities are more sensitive to your interest rate change, which is your higher duration, hence investor demand, higher yield for your longer maturities. So 10-year bond will have maybe higher yield than your 2-year bond yield, right? So these are few factors, keep in mind. 10-year will have higher than your 2-year, right? But these will be added in a distinct case. If there is a normal case, then you are happy with 6%. But if, let's say, you have a distinct case that you are looking at some particular kind of risk and all these are present, you will add all these, right? You plus, 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 right? You will add all three, right? But depending on the case, right? Depending on the case, I'll answer your question, guys. I got the notification. So what I'm trying to tell you here is that every interest rate that you see in the market, let's say 9%, 8%, 10%, that is like a layered kind of cake, right? Where the base is the real risk-free rate, then you have inflation premium, then you have toppings are like your risk-free premium, where you're adding a default, liquidity, and maturity, right? Together they make up the real your composition that investors expect from holding that security, right? So that's the whole point, right? So default risk premium, liquidity, and maturity, right? So little, I think, you know, some. I think this, this a move little bit. Okay, so keep that in mind. Very, very important, very straightforward, very simple, not much. Let me answer your question if anybody has. So, how the risk premium determined? See, risk premium determined on the basis of what exactly is the risk which the market perceives, right? It is all about market, right? How the market perceives the risk. Now, if market thinks that there is a Reliance bond, right? I'm talking about two corporate bonds. If there is a bond issued by Reliance, right? Market generally see that okay, Reliance is one of the biggest conglomerates of India, has certain kind of your cash flows and bank balance and cash and assets which are highly liquid and market has faith, right? Generally, that risk premium for default risk premium for Reliance will be very less. Now you take up some other company, right, which is not so great, right? So last year there was a company in India called Shapurji Palanji Group, right? Shapurji Palanji Group is a distressed company, right? And that they have to take out bonds, issue bonds at almost like 18%, right? So what I'm trying to put across is that Reliance will never take out bond at 18%, right? So there was a higher default risk premium for Shapurji Palanji Group because they were in distress. Market was expecting that lending them money is risky, right? So there was a default risk premium on Shapurji Balanji Group, but there's not a default risk premium on Reliance, right? So there are a lot of factors which are moving, right? Liquidity premium, again, liquidity premium is how many people are interested in buying and selling, right? Today itself, in fact, today similar thing happened. Okay, so see, I'll keep the class very interesting, guys, so that you learn real stuff. So today, just before your class, I was reading something, right? So today, just uh, I don't know if the fixed income news is there or not. Just give me a second. There's a lot of new news which is going around, uh, right? Crypto, US, but right. Okay, yeah, this is the news which I want to show you. Let me show you on screen. Right, I'll go, and since you are asking questions, right, I am uh, answering, right. I don't want to deviate, but if you will ask, I'll give you a very good example. If you guys ask, right, so please ask your question. I don't mind answering, and we have a lot of time also, so that is also a good part. Okay, so I'll show you an article which I was reading just before your class. I was reading. This is the article, right? This is just an article which came at 8:57 p.m. right, uh, on Bloomberg, right? Just 30 minutes before your class started. Treasury falls as supply outlook compound anxiety about Fed, right? So why I'm showing you this article is this is about the same thing is applied for treasury rates also, right? I gave you an example of corporate bond, but I'll tell you the same thing, right? So see here what treasury yields have hit highest since October, right? Yields have jumped up, right, today. Why they have jumped up? Because Treasury Department just now today evening the news came. Treasury departments have unveiled their plans for financing the U.S. government deficit over the November to January period, and they are considering future increases, right? So the prospect of cuts to long-term maturity auction size has been a minority view over the past years, right? So basically, maybe it's a little difficult topic to understand, but I don't want to go to so difficult thing. But what I'm trying to put across here is that today some news came, right? Today evening some news came, especially regarding that summaries here, right? Treasury fell after the US government signaled that large auction size are on the horizon, while signs of economic resilience hurt the odds a Federal Reserve interest rate cut in December, right? So now, since US government is signaling larger auction sizes means they will auction more bonds, right? When you try to auction more bonds means government is trying to raise money, right? But when government is trying to raise money, right, do we have the buyers of the bond? See, person who wants to buy the bond will only buy the bond when the rates are higher, right? So this was not the consensus view, right? Today, till yesterday, everybody thought that nobody is willing to, government will not do this. Now since government has come out with certain statement, larger auction sizes for the treasury bond, so people are believing that if large auction sizes have to pass through, then the yield on the bond should be higher. And considering that expectation, even though this will happen maybe in December or January, right? This just news came today, right? That's the beauty of interest rate markets, guys. Only the news came today that government is planning to have large auction sizes, and just the news came, and market judged it. Market thought that if US government has to issue bonds, somebody has to buy bonds, and if somebody has to buy bonds, like corporates have to buy bonds or individual investors have to buy bond, they would, what kind of yield they will prefer? So the whole thing is they will prefer higher yield, right? So see here, suddenly there has been a jump today. In last 24 hours, there has been a jump of almost like 8 9 bips, right? 8 9 bips on 10-year yield curve, right? So which is quite a steep jump, right? So your point that how does your premiums depend, so there are a lot of factors, guys. This, like, I have given you two different factors. One is for corporate bonds, this is for government bonds, right? So the world of bond is very interesting. The examples are very interesting, and these things have effects on equity markets and Federal Reserve rate cuts, etc. Right? So there are lot of moving wheels. So we'll understand slowly. This is what finance is. This is what you will understand. But right now I'll keep it short, not drag too much. But I gave you two examples. One is for your corporate bonds, one is for treasuries, right? Both cases, there were different reasons for rates to change. One case, the default risk premium has increased, right? Right now, what happened in treasury bond is that people are expecting that, okay, that demand supply we haven't discussed here, but demand supply is also one of the factors, because this is a big world, right? So you are learning right now only you're just scratching the surface, right? These are the most easiest part. When you go deeper you will realize a lot of other moving factors also. Okay, all right guys, let's move ahead. Let's do a easy question, guys. When you talk about the question, the nominal risk-free rate is best described as the sum of the real risk-free rate and a premium for what? Right, what is the premium for, guys? We have premium for uh, nominal. Nominal, we have premium for what? Please understand, nominal, we have premium for your inflation, right? So the inflation is the premium, right? Luckily, CFA only has three options, guys. That's a good thing about CFA. FRM and all has four options, so chances of getting a right option is good. Nominal has your risk-free rate, which I told you, nominal risk-free rate. Sorry, the real, not the nominal one. Hmm. So we saw just now in definition, very easy. When you are trying to find nominal is your real risk-free rate plus, what is the thing? Expected inflation, right? Inflation is the thing, right? Remember the rest three: default, maturity, and liquidity are case by case basis. These are case by case basis. Main main two are these only. Real and inflation are main two. This is case by case basis. Okay. This is case by case basis. That's why I told you 2 plus 4 is 6%. This is main. Then depending on case by case, right? So main is real risk free rate plus inflation. Rest these three will depend on if there is certain case or not. Generically, just simple scenario. This is your real risk free rate and a premium for expected inflation, right? See. So easy question, very easy, straightforward question. I don't think anybody should feel any problem here. Okay, so that's we have discussed, guys. I'm just moving ahead in easy question. If you have any doubt, please ask me. Next one is, which of the following risk premium is most relevant in explaining the difference in yields? Wow, this is what we discussed just now. Very interesting question, guys. Very interesting question. This kind of question comes in exam. Which of the following risk premiums is most relevant for explaining the difference in yield between a 30-year bonds issued by US Treasury and 30-year bonds issued by small private US corporation, right? See, both bonds are your 30-year, right? So both bonds are 30-year. Now, in this case, one bond is of US Treasury. Now, US Treasury is basically US government bonds, right? US Treasury is what I showed you right now. The Bloomberg, which I showed you, that was US Treasury, right? So that is very liquid because there are a lot of participants, right? Liquidity is very high, right? When you have your small private US corporate issuer like Shapurji Palanji Group, let's say, I'm just taking India example, small private US corporate issuer. I'm just taking, let's say, Indian equivalent. Right? It is like Shapurji Palanji Group. right? That liquidity will be low, right? Because not many players will be ready to participate there, right? So the basic difference is not inflation. The basic difference is not maturity. Maturity is same, 30-year and 30-year. Difference is liquidity. Okay. If you are new to the world of finance, sorry, I didn't ask your backgrounds, but if you're new to the world of finance, you might face little bit issues here to understand. But if you already know what it is, you will understand, right? But overall, the point which you need to keep in mind is that US Treasury is like a benchmark, and benchmarks are, the amount of money which is traded in US Treasuries is trillions of dollars, not billions, trillions of dollars. Trillions of dollars are traded in US Treasury. So liquidity is not high. I would say extremely high, right? Lot of buyers, lot of seller, international buyer, international seller. But when you go to a corporate bond, right, they're not buyers and less buyers and sellers, less buyers and sellers, and that's why price is kind of illiquid, and that's why there is liquidity low. Anybody in doubt can ask me, but I hope you guys know what is US Treasury market. Are you aware of what is US Treasury and corporate issuer, like uh, some idea? Yes or no? Anyone who doesn't have idea about this
Yes,
thing,
sir.
you have now, right? So yeah, so US Treasury bonds are highly liquid, where the bonds are small, issuer trades infrequently, and the interest rate includes a liquidity premium. That's what I told you. The liquidity premium reflects the relatively high cost as selling a position 2 months on the same maturity was same, right? Maturity was same. Inflation premium embedded in the yield of both bond is likely to be similar given both are US based, the same maturity, right? So try to understand, try to get to the meat of the topic. You will get the idea. All right, moving on. Next one is your holding period return, right? When I talk about holding period return, please try to understand holding period means how much time you are holding, right? It's a holding period, right? HPR, some people call it HPR, holding period return. Holding period return measures the percentage change in an investment value, right? Any investment which you are holding, percentage change in investment value over a specific holding period, right? Let's say you are holding a $100 bill, right? How much change the $100 investment has over a particular period, that is your holding period return, right? Now, again, since we are trying to study CFA, we are trying to understand the breakdown here. So it includes two components of return. One is your capital gain loss, second is your income yield. Capital gain loss is your change in the price of the asset. Let's say 100 investment became 110, right? So it is 10 rupees profit, right? So that's the capital gain loss, right? Income yield is the cash flow received from the investment. Let's say there are dividends or interest payments in between, right? So there are bonds which have dividends. So, and that is the case. Now, this is a very common question in CFA that you have to calculate the holding period return. Holding period return is calculated the sum of income and the capital gain divided by the initial investment value. Again, looks like a very difficult formula, but this is a school kind of formula, guys. Basically, what did we learn in school? School, when we have to calculate our percentages, etc., right? So the whole thing what we used to do, right? It is like we used to say now that how much we have gained, right? The gain value is that you will say that okay, my capital gain is my new price minus old price, plus if there is any other dividend or your coupon, etc., dividing by the old price, right? P naught, right? So it's a very straightforward, right? It's like a school kind of stuff. So don't worry. The tricky part is this, right? Tricky part is this, that people, if they don't remember this formula, they get little confused. So, for example, if I say to you that your holding period return in first year was 10%, second year the holding period return was 5%, third year the holding period return was 3%. What is the holding period return for the combined 3 year? Then people get, suddenly surprised that how will I calculate that? So, answer to this is 1 into your 10% 0.10, right? 1 plus your 5%, right? And 1 plus your 3%, right? And you have all three things, right, multiplied, and you do minus 1, right? So this kind of surprise people when they do it for the first time. Otherwise, I don't think that even CFA will ask this question. This is pretty straightforward. But this is the tricky part, guys. Try to understand this. And again, not tricky part, I think. It's just the multiplication, right? Please keep in mind that holding period return is the real world investors measure, because you are combining two things. You're saying that, okay, this is the profit I have when I bought and I sold, and in between when I bought and sold, I received this much of income as a dividend or interest payment. So I'm incorporating both that, pt minus p0 plus dividend t divided by your p, combined divided by p. If you hold an asset longer, you use compounding to find your total holding period return, not just your average, right? So keep that in mind. Okay, we'll do the question ahead, guys. There will be question ahead, so keep this. I've seen a question here, one odd question, so just keep this in mind. Okay, next one is average return, right? Next one is average return. Now, when I talk about average return, basically when returns vary across multiple periods, right? You might have some periods where you have positive return, some period you have zero return, some period you have negative return, right? Then it is an onus on you that you decide how to summarize them. Now, CFA, what it does is that say that you have different methods to summarize, right? Take an average. Three main methods are there to summarize. One is your arithmetic mean, one is your geometric mean, one is your harmonic mean, and we should know where to use what. Right? That's the whole idea. That you should be able to understand that how to find arithmetic return, geometric return, harmonic return, and then where to use what, right? Which we'll see in the next slide. So arithmetic return is most simplest, right? Just add, take the average, right? This is the most basic kind of thing. Add all, right? Add all and divide by your n number of observations you have. This is a very simple, uh, straightforward kind of thing. When you want simplest of returns, you take the arithmetic return. But the point here is the arithmetic mean return does not capture compounding. So there is no funda of compounding in arithmetic return because it is simple average, right? Simple average does not have your any compounding. Then we have geometric return. Geometric return is a compound rate, right? So here we are incorporating one of the most fundamental principle of finance, that compounding, right? So when periodic rates of return vary from period to period, the geometric mean return will have a value less than the arithmetic return, right? So again, this is a property which you need to remember. Let me highlight with different color, because these kind of results are tested in the exam. They will ask you when periodic rates of return vary period from period, which is higher, geometric is higher or the arithmetic will higher, right? Please keep in mind that geometric will be lower, arithmetic will be higher. See, arithmetic is simple average. Geometric, when there is a lot of variance, right? So in that case, like the general principle here is that general idea here is, let me write down, geometric always always less than arithmetic mean or arithmetic uh, mean or arithmetic return, unless returns are identical, right? This is a property, guys. This is a property. This has been seen. The logic is same, right? Basically, you are taking under root, right? And you are not under root. In fact, root of n, right? You are multiplying all this, 1 plus r1, 1 plus r2, 1 plus r3. You are multiplying so many, and that's, let's say there are 10 observation, right? So you're taking root 10, right? N minus 1, right? So this is always returns are lesser than arithmetic mean, unless one property, unless it is equal, right? And third one is harmonic mean return. It is used for your averaging cost or used for your rates, especially when values are expressed as ratios, right? So this again confuses people, that where do we use harmonic returns. Let's say if your share purchase cost are, let's say, 20, 25, 40, right, per unit for three purchases, right? Harmonic mean will give you average price per share reflecting your equal money invested, right? So whenever you have to find the average cost, right, per unit, etc., that time this is very useful, right? So harmonic mean has a use that you're looking for average cost per unit, right? So I'll answer your question. I think that one or two questions which have come before I stop, before I come to your question, let me put a final flavor to it. That please understand that arithmetic return, when I talk about arithmetic mean return, is very simple. Expected return, single period forecast, very simple, just add and divide. Geometric return is multi-period, right? Geometric return is generally multi-period, right? And here you are adding your compounding, right? So compounding principle you are using. Harmonic is more about average cost per unit, average price per unit. Uh, Generally, the amount or the logic here they talk about, it is more about when you are investing, your equal money per period. Okay. So harmonic mean is generally used when you are investing equal money per period. Okay. That's what we try to achieve, right? So overall, the idea is that you understand there are three main methods of calculating your averages, at which method to use where. That is very critical to understand, right? Arithmetic means generally what you expect on average. Geometric means that what you actually get after compounding. Harmonic means that uh, what you effectively pay when you are investing equal amount per period, right? So in simple words, if I would have to give you whole thing as a simple line, just remember arithmetic is like which is taught in your primary schools, right? Young kids learn generally arithmetic. Why they learn arithmetic? Because arithmetic is like the ideal case, or you can say, uh, hopefully things should be like this. Geometric is what is the reality. Geometric is the real world case reality when you say that no, for every period we will have compounding. Harmonic is more about, you're talking about that cost efficiency. You're talking about that what if I have invested same amount of money in all periods, right? Harmonic is most about cost efficiency, right? So each one has different usage, right? So please keep that in mind very, very clearly, that averages are calculated in different ways, and each average has a different use case, right? Here also see, the definition of harmonic return is you're taking n on the top, and below you are taking 1 by xi, right? Because you are saying that money, or like 1 by third money or 1 by fourth money is invested every time. When you solve the question, you will understand, right? But overall, please understand that before I answer your question, please have this clarity in mind. Just let me go to your questions now. Okay. Okay, fine. I think student joined again. That's fine. Perfect. Okay, it's very interesting. This please understand harmonic and geometric again. Rest, I think you can understand. That's not an issue.
Sir,
Uh, go on. Please ask.
sir, average cost per unit, does that actually mean same investment class or
Yes.
different investment classes?
No, no. Same investment in different tranches, right? Let's say you are investing the same amount in three times or four times,
Understood.
right? So that's the harmonic mean, right? Let's do the question. You will understand, right? Again, okay. Before doing the question, let's understand the property. So relationship between your arithmetic, geometric, and harmonic mean, very important. Please understand this property, very, very important. Arithmetic mean into your harmonic mean is geometric mean square, right? Again, see, that's why I give you hacks, right? The whole idea is like I gave you, right? Arithmetic mean is what you hope, right? But you ideal case. Geometric mean is what you get in reality. Your harmonic mean is efficiency, cost or efficiency, right? Cost efficiency, right? Again, it becomes very easy, right? You basically you are multiplying this into this, right? This into this is equal to gm into gm, right? So the idea here is that when you again I don't know you will understand this hack or not, but if you have to teach somebody to a layman who doesn't understand mathematics, you can say that very very simply that see hope and cost efficiency multiply, then you get reality, right? So it is that kind of thing, right? So but again there are two things multiplied, that's why we have to do square, right? So that is what again this thing when values are not all equal. See, when values are equal, then things are different, right? Then your geometric mean and arithmetic mean are same. But values are not equal. That case, you have harmonic mean, then you have your geometric mean, and when you have your arithmetic mean, right? That appropriate uses for various data and measure are as follows. Arithmetic mean include all values, including your outliers. Geometric mean compound the rate of return over multiple periods. Harmonic mean calculate the average share which you ask from periodic purchases in a fixed money amount. Trimmed mean means decreases the effect of outlier, right? So you are actually saying that okay, reduce the uh, trimmed mean means that again this is not discussed much in your syllabus. Also, this is not calculation, but what happens in finance is that sometimes you feel that there is one outlier, like COVID times, right? COVID time was a clear outlier, right? People say that that is not what is reality, right? So we can ignore a particular year when you're considering 20 years because COVID year things fluctuated very wildly, right? So you decrease the effect of outlier. So you take a mean where you have one less value, right? So that is what we try to add. So why geometric mean less than arithmetic mean? If it is compounding, then shouldn't the effect of compounded make it, higher? See, uh, again, this is a very common confusion among students. You're applying the concept, but in a wrong way, right? See, the compounding, the return is okay. Let me explain it in the okay here only. Let me explain. See, the idea is that you are asking, sir, why is geometric mean less than your arithmetic mean? The point is, geometric mean, the value of geometric mean, uh, when we, okay, when we say, na, like what you, the statement which you made, right? I'm just countering that statement. You have applied a correct statement in a little wrong way, right? Why it is little wrong way? Why I'm saying is, see, geometric mean gives you higher return, right? I agree, but that is that when we take geometric mean, so things are compounded. Ultimately, in compounding, right? What we are saying is that what you are talking about is that I compound things, and how the things compound there is that you take let's say 7%, right? So if you take 7%, you are saying, sir, 7%. If I take simple interest rate, I take 7%. But if I take what will give me 7% by your uh, okay, let me go to a sheet. The space is less. Okay, so let's write here. Okay, so the whole concept here is if I tell you that I want 7%. So if you want 7% return, right, to achieve a effective interest of 7%, what kind of compounding I want. See, compounding, how does compounding work? If I have your, you know, annual compounding, it is 1 plus r raised to power 1. If I have your semi-annual compounding, it works like this. If I have quarterly compounding, it works like this. If I have monthly compounding, it works like this, right? If I have, let's say, daily compounding, right, it works like this. If I have, you know, continuous compounding, then it becomes exponential RT, right? So what I'm trying to put across now, you see yourself. If I say that 1 plus r, right? See this funda. If I say 1 plus r, sir, I need 1 plus r is equal to 1.07, because this is 7%. Na? The r is equal to 0.07. It's 7%. But when I do this part, 1 plus r by 2 square, and I need 1.07. Now you calculate the r value here. Calculate r value here, guys. What will be? 2 plus r divided by 2, 1.07 under root. If I do 1.07 under root, I'm just showing you an example, right? Basically, you are not telling wrong, but it is just the concept applied. 1.07 under root I am doing, right? It is 1.0344, right? So this is gone now. This is on that side. So 2 plus r divided by 2 is equal to 1.0344. 2 plus r is equal to, I multiply it into 2, you do it, into 2 I do it, it becomes 2.0688. R is equal to what? 0.0688. Isn't it 6.88% now? Yes or no? Have you seen?
Yes, sir.
Right? So what has happened now? You will say suddenly, see, the point here is why I'm saying you have applied the concept opposite way. What I'm saying is that 6.88% when compounded will give me as good as a result which 7% not compounded or arithmetic mean will give. 6.88% compounded, 6.88% semi-annual compounding, SA compounded, gives me equivalent to result 7% arithmetic. So that is why geometric is lesser. Are you getting my point? That geometric smaller thing gives you bigger. So your concept is right. What you are saying is right. That, sir, geometric should be higher. Yes, geometric should be higher, but geometric is a smaller part of geometric is giving me a bigger effect, nah? Or if you put in, let's say, simple cricketing, let's talk about a little bit of cricket, right? If I talk about cricket, if I say to you that simple point that India sends its B team, B cricket team to Zimbabwe and they beat Zimbabwe, right? So which cricket which so what can you say about India A team? And assuming India A team is better team than India B team, so you will say na that, oh, India B team is able to beat Zimbabwe, right? So India A team is much stronger than that. So basically, if our lower value, right, our geometric mean 6.88 is equivalent to 7% of arithmetic mean, right? So geometric mean 6.88%, geometric mean 6 semi-annual is doing as good a job as the arithmetic mean of 7%. Does it make sense a little bit?
Yes, that makes sense. It's just a little confusing because they are using the same numbers to calculate both the means. So, how come it becomes
No,
6.88%
no,
to
no.
equivalent to 7? Because if it's the same set of numbers that are given, for the same set of numbers, you get a lower geometric mean and a higher arithmetic mean.
No, see, same set are not used. Na? Not all equal. I have written. Na? Same set are not there. Na? Same set things will change. See,
So if
not
you
all.
are given one set of numbers and you are asked to take out the geometric mean and you're asked to take out the arithmetic mean,
Right.
which one will be higher? Arithmetic?
Yes. See, when the numbers are not equal, right? The mean higher will be arithmetic, right? Mean higher will be arithmetic, right? But geometric mean basically is a compounded mean, right? Because it is using compounded. So when you will add the compounding, whatever raised to power you will add, that will give you equivalent effect till your arithmetic mean, right? So the whole idea is this only, that what I did here, that if you want to achieve the desired effect of 7%, right? If you want to, let's say your objective is to get 7% return, right? For that, arithmetic mean you have using, you have to use 7%. But geometric mean you can achieve the same thing 6.88. Now, if I take it, uh, let's say quarterly compounding, I take 4 period compounding, I take quarterly. Now, let's solve this. Let's say 1 plus r by 4, right? I try to get 7% in a quarterly compounding, 4 time compounding, right? Quarterly compounding, right? You see, this will value will go down much again lower, right? Now I take what 1.07 par 4. This is a very like this confuses a lot of people, to be fair. So not a what you say a doubt, very common doubt. 1.07, if I take raised to power 0.25, right? The answer comes out as your 1.017, right? And r by 4, I do it in -1. So r becomes 0.017, right? 170, let's say, to make it more precise, 170, right? R becomes 0.170 into 4, right? -1 is equal to into your 4. So this becomes now 6.82, right? So you are seeing here. Here I need, when there is no compounding, I need 7%, right? Then I need the value of R as 7%. When there is when there is 6 monthly compounding, I can get the desired result of 7% by 6.88%. When there is 4 time compounding, I don't need 6.88 also. I can do it by 6.82. As the compounding is increasing, as the number of compounding period is increasing, right? My, the rate is going down and down, right? So to achieve the desired result of 7%, I can do by lesser geometric mean. So the question, uh, the statement which is given in your book is given is that uh, for values that are not all equal, right? You can, what is the way to achieve the same thing, right? So here the constant, like what they are trying to compare in this thing is not the results, not the results. They are trying to show is that for a given value, for a given value, for a given result, for a given result, right? The result is given. Let's say the same thing, 7% is given. For a given result, which value will be higher? So you saw them yourself, right? That for a given value, I need arithmetic return of 7%. For geometric, I can achieve by your 6.88 also. Got some idea a little bit?
Yes,
Yeah,
I
so
get that perspective.
yeah. So that's what they are giving, right? But again, very common confusion. So that's perfectly okay. So keep that in mind, right? Ultimately, they are talking about a given result. So result they have fixed, like I fixed the 7%, and then they are saying that okay, you can achieve the same thing by lesser one, right? Let's do the question, guys. This is quite interesting. So let's do the question here, right? Consider the annual return for fund Y, right, over the past 5 years. Year one is 19.5, year two is minus 1.9. 5 different years, 5 different returns are given. Now they are asking you geometric return, right? Geometric return for fund Y is closest to, again, geometric return, compounding return, under root they have to do, right? So that's what we have to achieve, right? So and same thing, if you just, for you guys, I'm taking you back to the formula so that you remember it. It is 1 plus r1, 1 plus r2, 1 plus r3, 1 plus rn, minus the bracket, the under root finishes at 1 plus rn, then take the root n and minus 1. So in this case, we will have root 5. Right? In this case, we will have something called root 5. Right? Root 5. And then we have 1.195, right, into your, obviously it will be subtracted, so it will be uh, 1 minus something, 1 minus, so 0.981 would be there, not 0.981, uh, yeah, 0.981, right, and then 19%, 1.197, right, and no, it's 1.9, na? So sorry, 0.81, sorry, 0.81 would be there, 0.81, just a second, guys, 0.81 would be there, and this will be into 1.197 into 1.35 into 1.057, right? So you take, multiply all these, take the fifth root and minus 1. All these have to be done in calculator, guys. Let's see the what they have done, right? This is what they have, right? So same thing which I told you. You have to, again, this all things have to be done in calculator, guys. 1 plus this, 1 minus this, right? This one raised to 1 by 5 minus 1, right? 1 minus, I think the number I'm putting wrong. 1 minus 0.019, sorry, 1 minus 0.019, 981. I think early the first number I have taken was right. So just be cautious here, guys. Use calculator, right? You saw yourself that I did a stupid mistake, not 0.81. Earlier I written correct 981. Right. So simple, straightforward, not very difficult, right? So you can do it. So that is one. Let's do next question. A portfolio manager invest euro 5,000 annually in a security for 4 years at the following purchases. Again, see, purchase price. This should give you a hint. Purchase is mostly for, you have to see that some person is investing annually security for 4 years at the following, right? So how much he is investing, right, and whether he is investing your equal amount or not. So I told you very clearly, when you are investing equal amount, so portfolio manager invests euro 5,000 annually. So what was that equal amount investing, guys? What was the best thing to use there? Which one? Arithmetic?
Harmonic.
Harmonic, right? So even though you don't have to even solve the question, right? It comes out automatically that okay, equal amount investing, right? The best thing to use there is harmonic, right? We can obviously solve it, but the point is that it you should click your mind immediately that geometric is more for compounding, right? This is for straightforward, simple way which is less used. right? But when you have to equal amount investing, then it is harmonic, right? And then how do you find out this? Then you have n divided by 1 by x. That is what is happening here, right? See, so n is 4, right? And then 1 by x, 1 by 62 plus 1 by 76 plus 1 by 84 plus 1 by 90, right? Then it came out to 76.48, right? So that is the thing, right? So the formula for harmonic mean was n summation, right? 1 by xi, right? I told you 1 by xi, right? So you have to solve it, okay? So that is what we have. So pretty straightforward. Go back and practice it. Obviously, you will get the notes, etc. But go back and practice. Let's do a theoretical question. Which of the following statement regarding arithmetic and geometric means is correct? Right. So let's try to understand it. The geometric mean will exceed the arithmetic mean. No. For a series with non-zero variance. No. Geometric mean, I told you, will always be less than arithmetic mean if it is unequal, but if it is equal it will be equal, right? If all the numbers are equal it will be equal, but it never exceed, right? It will never exceed. So this goes away. The geometric mean measures an investment's compound rate of growth for multiple period. That seems okay. Arithmetic mean measures an investment's terminal value over multiple periods. There is no question of terminal value, right? Because we never discuss any terminal value, right? It's just a simple average, right? It's not a right. It's a simple average. Arithmetic mean is simple average. There is nothing, no concept called terminal value, right? So option is B. Right, that the CFA has this good thing that there are three options. FRM and all has four options, right? So it becomes more difficult and challenging their four option selection. Here at least, the getting each option right is 33% chance, right? It's a B1. Okay, same thing, more accurate. Just read the answer. The geometric mean compounds the periodic return of everything, giving the investor a more accurate measure of the terminal value of investment. So now this part we missed out, right? Just understand your geometric, right, gives how money actually grows, right? Arithmetic mean is just about a forecast, right? Expected 1 year return, right? And geometric mean is your multi-year return, etc. That we keep in mind, right? So that is what we have. So this is done. Okay. All right.